Peter from BibleMoneyMatters.com here, today talking about short sales and foreclosures a little bit as well. The question today is, will a short sale hurt your credit? And even if you were to do a short sale, would you really even qualify for one? We've been hearing a lot about short sales and foreclosures over the last few years as we've gone through a bit of a debt crisis and a real estate bubble. Tons and tons of people, thousands of people, are finding themselves underwater in their homes, where they owe more on their house than their house is worth. My wife and I are in a similar situation where the value on our home has dropped by between $70,000 and $80,000 in the last few years since we bought our house back near the height of the market around 2006, 2007. When you're finding yourself with such a huge drop in value of your house and you want to move, it can quickly become a problem because again, you owe more on your house than you can get for it if you were to sell the house. What a lot of people are doing are trying to do a short sale prior to going down the road of doing a foreclosure, just because they believe it's going to be a better situation than if they were to default and go into foreclosure. So today I kind of want to talk a little bit about that situation, how a short sale works, and whether or not you should do one. Now, part of the reason why this came up for me at my house is because, again, we might not be able to get as much for our house as we currently owe. Again, our value dropped by about $80,000 over the past few years, and because of that, we were looking at buying a new house. We're not in any bad financial straits or anything like that, but again, we would be losing out if we were to sell our house, probably. My mother-in-law decided that what we should do is go into do a short sale. I don't think she really understands completely about how a short sale works or what it does to your credit, so I wanted to do a little bit more investigation and look into that. So first of all, what are some reasons to do a short sale? First, there are some reasons why you shouldn't do a short sale. First of all, if you just want to buy another home, the lender's not going to care if you want to move to a different location or a bigger home. They're not going to say that just wanting to move is a good reason to do a short sale, and you may not qualify. Having a pregnancy, if your family, if the size of your family is increasing or expenses are increasing, it doesn't matter. The bank doesn't care. It's not a qualifying hardship expense. If you're spending all your money on things you don't really need, having irresponsible spending habits and not having enough money to pay your mortgage are not a qualifying hardship expense. Bank's not going to like it. Maybe you found out that you've got some really bad neighbors and you're all drug dealers or prostitutes or who knows what. Well, that's not a good reason or a qualifying reason of why to get a short sale. It's just not. Some good reasons of why you may want to do a short sale. First of all, if you've become unemployed, if you've lost your job or source of income, that might be a qualifying hardship. A bank will see that, hey, your income has dropped and you might not be able to make payments. A bankruptcy, if you've gone into bankruptcy, you don't have the money to pay your mortgage, it's obvious if you've done a bankruptcy, that's probably the case. It's probably a qualifying hardship for you to do a short sale. If you have a death in the family, that might be a qualifying hardship because, again, a lot of times that means a drop in income. A divorce and loss of dual income could be another qualifying hardship. Or health problems. Maybe you've had a medical situation where your health is bad and you haven't been able to work and you've got tons of medical bills. That might be a qualifying hardship as well. So what are the consequences of doing a short sale? Well, first of all, let's back it up here a little bit and talk about what you need to do in order to get a short sale. First of all, you need to contact the lender. You need to talk to the person who's capable of making a decision on a short sale and get the process started and talk to them about doing a short sale. A lot of times some lenders will say you need to be in default already for a month or two before they will even consider doing a short sale. Some other lenders will be a bit better about it, however, and allow you to do a short sale without missing any payments or anything like that. And usually that's going to mean it's better for your credit as well. So first of all, you need to contact your lender. Things they're going to ask for usually are a preliminary look at the numbers, how much you'll sell your house for and how much the shortfall is going to be, how much they're losing. You need to give them a hardship letter explaining why you need to do a short sale. Again, we've already talked about some good and bad reasons of why to do a short sale. You're going to need to give them proof of income and assets, copies of bank statements, comparative market analysis showing prices of similar homes in the market and what they're selling for. And finally, when you find a buyer, you have to give them a purchase agreement, and they have to approve the actual short sale itself. A lot of times you'll find that banks don't want to approve these, and you end up going, or they approve it really slowly, and you end up losing a buyer because it takes just too long, months upon months. So even if you go through with a short sale and you are approved for doing one because you have a qualifying hardship, what are the consequences of doing a short sale? First of all, you're going to have a ding on your credit report. Depending upon exactly how you do the short sale, whether or not you have missed payments on your mortgage and so forth, the ding on your credit could be anywhere from 50 to 300 points. It really depends. I've heard a bunch of different stories from different people. Usually if you haven't missed any payments and you're able to work something out, it's going to be a smaller ding than if you miss payments and so forth. A lot of times if you have missed payments, the ding on your credit report is going to be just as bad as if you went into foreclosure, basically because the banks see that you're not holding up your end of the bargain, you're not paying the amount you agreed to, and it's a loss for the bank either way, and they don't care why or how that reasoning is. There could be tax or debt consequences, although this may be up for debate a little bit. Might be through the year 2012 you may not have to repay any of the shortfall amount for what your house sold for versus what it's worth. So again, finally, the biggest thing is probably going to be the credit ding. You're going to see a big drop in your credit score, and along with that, it's going to make it difficult or impossible to get a home loan, depending on what kind of a short sale you did, for at least 2 years, but could be up to 5 years if it's a foreclosure. Again, it's going to vary from situation to situation. So be aware of the consequences, the ding to your credit, possible tax or debt consequences, and don't go into it lightly thinking it's just a way to get out of some of your debt. It is going to have some negative consequences, and it's really not a great situation for anyone. So I understand there are some situations where some people will need to go down that road, but I would try to avoid it if you can.